I have spent my life in the company of numbers. They are honest, unforgiving, and utterly indifferent to human emotion. If you are here, you are likely searching for an edge, a secret formula, a grand, sweeping insight that will unlock the markets. I can tell you, after decades of observation, after building an organization that has consistently outperformed every benchmark and every competitor, that the secret is not grand. It is small. It is subtle. It is mathematical. The greatest mistake I see, the one that has crippled more fortunes than any market crash, is the belief in the heroic trade, the conviction that success in finance is about a single, brilliant prediction, a moment of genius where you see what no one else sees. This is the narrative of Wall Street, the drama that sells books and fuels the emotional roller coaster of the amateur. It is a delusion. I've watched people repeat the same mistakes for decades, and the root cause is always the same. They mistake the market for a casino where luck is the primary currency, or a courtroom where a compelling narrative wins the day. The market is neither. It is a vast, complex, and highly efficient machine, and the only language it truly understands is mathematics. I've seen brilliant minds fail because they overlooked one simple truth. The market is a reflection of human behavior, and human behavior is statistically predictable, even if individually irrational. My thesis is simple, yet profound. The $60 billion empire was not built on a single monumental insight, but on the relentless, unemotional compounding of thousands of tiny, almost invisible statistical advantages. We are not prophets. We are mechanics. We do not predict the future. We react to the data. We do not seek the home run. We seek the consistent fractional advantage that, when executed millions of times, becomes an insurmountable force. The traditional approach, the one driven by gut feeling, by news headlines, by the fear and greed that cycle through the human mind, is fundamentally flawed. It is a system designed for failure because it is built on noise, not signal. The market is not a mystery to be solved by intuition. It is a complex, chaotic system that can only be understood through the lens of mathematics. I will share with you the 4 core principles, the mathematical truths that allowed us to transform small edges into a colossal, enduring success. These are not trading tips. They are philosophical shifts in how you approach the world of finance. The first principle is an understanding of the signal-to-noise ratio. In any financial market, the vast majority of the information you receive, the news, the punditry, the daily chatter, the expert opinions, is noise. It is irrelevant, distracting, and designed to provoke an emotional response. It is the static that drowns out the transmission. The true signal, the small, persistent inefficiency that can be exploited, is buried deep within the data, often so faint that a human mind cannot perceive it, let alone act upon it consistently. Consider the example of a simple coin toss. If a coin is weighted to come up heads 51% of the time and tails 49%, a human observer watching a few hundred tosses would never be able to reliably predict the outcome. The noise of the individual toss, the 49% chance of tails, would overwhelm the signal. A human trader operating on a hunch after a few wins would inevitably be wiped out by the randomness. They would be tempted to double down after a streak of heads or abandon the strategy entirely after a streak of tails, mistaking short-term variance for long-term invalidity. The human mind is wired to see patterns where none exist, a phenomenon known as apophenia. This is a survival mechanism in the jungle, but a liability in the market. But a mathematical model, a machine built for relentless, unemotional execution, does not care about the individual toss. It cares only about the expected value. It knows that over 1 million tosses, the 51% edge will not only manifest, but will compound into a certainty of profit. This is the power of the law of large numbers applied to finance. The individual trade is a random variable, but the aggregate of millions of trades is a statistical certainty. The key is to survive the short-term randomness long enough for the long-term statistical truth to assert itself. This is the essence of the small edge. It is not about finding a pattern that works 80% of the time. Those patterns are either non-existent or quickly arbitraged away by the collective intelligence of the market. Our work was about finding patterns that worked 50.7% of the time, or 50.2% of the time. These are edges so small that they are statistically invisible to the emotional, short-term human trader. They are the subtle, transient imbalances in supply and demand, the momentary overreactions, the predictable patterns of market microstructure that exist for mere seconds or minutes. We are exploiting the tiny, predictable ripples caused by the collective, irrational behavior of millions of human participants. The psychological mechanism at play here is the human need for certainty and narrative. We crave a story. The stock went up because of X news. Our models, however, are agnostic to the story. They simply observe that when condition A, B, and C are met, perhaps a specific volume profile, a certain time of day, and a particular volatility level, the probability of a short-term price movement in direction D is marginally higher than random. The model does not need to know why. It only needs to know that the statistical relationship holds. The moment you introduce a narrative, you introduce a bias, and that bias is a contaminant to the mathematical purity of the system. To apply this, you must first acknowledge the noise. You must filter out the narratives, the opinions, and the emotional appeals. You must train yourself to look for the faint statistical signal that persists beneath the surface. This requires a profound shift from qualitative reasoning to quantitative reasoning. You must stop asking, why is this happening? And start asking, what is the statistical probability of this continuing? The latter is a question a machine can answer. The former is a question that leads to emotional ruin. The pursuit of the 50.7% solution is the pursuit of statistical truth over comforting fiction. It is the recognition that in a highly efficient market, the only remaining edges are those too small and too fleeting for the human mind to exploit. This is the first great lesson. The market is not about predicting the future. It is about quantifying the present. The practical implication is the necessity of high-frequency trading. The smaller the edge, the more frequently you must execute it to realize the statistical advantage. If your edge is 0.7%, you need thousands of trades to ensure the statistical distribution converges to the expected value. This is why we built the infrastructure we did. The speed of execution is not a luxury. It is a mathematical requirement for exploiting the smallest, most transient edges. For the individual investor, this translates to patience and volume. You must be patient enough to let the statistical edge play out over a long time horizon, and you must have enough volume of trades or positions to ensure that the law of large numbers works in your favor. A single large bet on a 50.7% edge is still a coin toss. 1,000 small bets on a 50.7% edge is a statistical certainty. The second principle is the necessity of orthogonality and systemic diversification. If you have a single strong trading strategy, you are vulnerable. If that strategy fails, your entire portfolio fails. This is the financial equivalent of a single point of failure in an engineering system. The market is a dynamic environment. Any single edge, no matter how robust, will eventually decay as others discover and exploit it. Relying on one strategy is a guarantee of eventual obsolescence. The market is a vast, complex ecosystem, and a single strategy is merely a single species susceptible to extinction. The genius of the Medallion Fund was not one brilliant strategy, but the combination of dozens, then hundreds, of small, independent strategies. We did not seek one large edge. We sought many small edges that were orthogonal to one another. In mathematics, two vectors are orthogonal if they are independent, meaning a change in one does not affect the other. In finance, This means finding trading signals that are uncorrelated. If one strategy is based on the short-term mean reversion of commodity prices, and another is based on the long-term trend following of currency pairs, their successes and failures are largely independent. They are operating in different dimensions of the market. The failure of one does not imply the failure of the others. This is the bedrock of true risk management. Imagine you have 50 different strategies, each with a 50.5% chance of success on any given day. If you bet all your capital on a single one, you have a 49.5% chance of losing a significant amount and a high probability of a catastrophic drawdown. But if you divide your capital equally among the 50, the probability of all 50 failing simultaneously drops exponentially. The losses in one strategy are consistently offset by the gains in others. This is the mathematical magic of diversification. The whole becomes vastly more stable than the sum of its parts. The volatility of the aggregate is significantly lower than the volatility of the individual components. This is the mathematical mechanism of risk management. The individual edges are small, volatile, and often short-lived. But the systemic edge is massive because the risk is distributed and the returns are aggregated. The overall portfolio becomes robust, resilient, and predictable, even though the individual components remain volatile and uncertain. We are not betting on the success of any single model. We are betting on the statistical certainty of the aggregate. This is the concept of ensemble modeling applied to finance. By combining many weak predictors, you create one powerful, stable predictor. The psychological barrier to this principle is the human desire for concentration. We want to be right, and we want to be right big. We want to put all our eggs in the basket we believe in most. This is ego-driven investing. The quantitative approach is ego-less. It acknowledges that no single human or model can be right all the time. It embraces the certainty of being wrong on individual trades, but the statistical certainty of being right across the system. The human mind seeks simplicity. The market demands complexity. The analogy I often use is that of a complex machine. A jet engine is not a single, perfect component. It is thousands of small, imperfect components, each performing a simple, reliable function. The failure of one small sensor does not bring down the plane. The system is designed to absorb and compensate for local failures. Your investment portfolio must be a machine, a system of systems, not a single, fragile instrument. You must continuously seek out new, uncorrelated sources of small edge and integrate them into a robust, diversified system. This is the only way to ensure survival and long-term compounding. The search for orthogonality is the search for true resilience. It is a realization that the greatest edge is not in the prediction of a single event, but in the construction of a portfolio that is immune to the failure of any single prediction. Furthermore, the concept of orthogonality extends to the time horizon of the trades. Our models operate across multiple timescales, from seconds to weeks. A short-term mean reversion signal might be orthogonal to a longer-term trend-following signal. This multi-timescale approach further stabilizes the portfolio, ensuring that the system is not reliant on a single market condition. When the short-term signals are struggling due to low volatility, the longer-term signals may be thriving, and vice versa. This is not just diversification of assets. It is diversification of time and strategy. For the individual, this means having a clear separation between your long-term passive investments and any shorter-term active strategies you employ. Do not let the noise of one contaminate the signal of the other. The third principle is the discipline of unemotional execution. A model is only as good as its execution. If a model dictates a trade, that trade must be executed instantly, precisely, and without human intervention or second guessing. The human element is the single greatest source of error in any financial system. The human mind is a terrible trading instrument. It is plagued by cognitive biases, confirmation bias, recency bias, and most destructively, the disposition effect, the tendency to sell winners too early and hold losers too long. These biases are hardwired into our psychology. They are the remnants of an evolutionary past that rewarded caution and emotional response. In the high-frequency, high-stakes world of modern finance, they are fatal flaws. The moment you feel a surge of excitement or a pang of fear, you are already compromised. Your rational mind has been hijacked by the primitive, short-term survival instincts of your limbic system. I recall a time early in the fund's history when a model signaled a massive short position in a particular equity. The news cycle was overwhelmingly positive. Every analyst on television was touting the stock. The human traders on the floor were skeptical, arguing that the model must be wrong, that the fundamental story was too strong. The model, however, was not reading the news. It was detecting a subtle, short-term structural imbalance in the order flow and price action. It was a purely mathematical observation devoid of narrative. The model was simply stating, based on the data, the probability of a downward movement in the next hour is 52.1%. Had we listened to the human intuition, we would have missed one of the most profitable trades of that quarter. We did not listen. We executed the trade precisely as the model dictated. The stock briefly rallied, testing the conviction of the human observers. But then, with mathematical inevitability, it collapsed. The human mind seeks validation. The model seeks profit. The human mind seeks to be right. The system seeks to be profitable. These are not the same thing. The lesson is not that the model is infallible, but that the process must be infallible. The model will be wrong 49.3% of the time. But the moment you override the model based on a feeling, a headline, or a hunch, you have destroyed the integrity of the entire system. You have replaced a statistically proven, unemotional process with a single, emotional, and statistically insignificant human judgment. You have introduced noise into the signal. This is the moment the system breaks down, because you have substituted the law of large numbers with the law of human error. The mathematical mechanism here is the concept of reversion to the mean. Over time, the small edge will assert itself, but only if the system is allowed to run its course. Every emotional intervention is a deviation from the expected value, a tax on the system's long-term profitability. The small edge is fragile. It requires a perfect environment of consistent, high-speed execution to survive and compound. The cost of human intervention is not just the loss on a single trade, but the systemic damage to the integrity of the entire statistical process. For you, the individual investor, this means you must codify your rules. You must define your entry and exit points with absolute precision based on objective criteria, not on how you feel about the market that day. You must pre-commit to your strategy and then execute it with the cold, hard discipline of a machine. When the market moves against you, your only question should be, has the underlying statistical edge been invalidated by new data? If the answer is no, you hold the course. If the answer is yes, you exit instantly and without regret. Regret is an emotion, and emotion has no place in a financial equation. The discipline of unemotional execution is the bridge between a theoretical edge and realized profit. It is the commitment to the long-term statistical truth over the short-term emotional impulse. This is the second great lesson. Your greatest enemy in the market is not the market itself, but the human operating the account. The fourth and final principle is the establishment of a scientific culture. Our success was not merely a function of the models we built, but of the environment in which they were conceived, tested, and deployed. The financial world is dominated by MBAs and economists. We staffed our firm with mathematicians, physicists, and signal processing experts. We treated the market not as a business problem, but as a scientific one. We understood that the market is a physical system governed by forces that can be modeled and quantified, much like the weather or the movement of celestial bodies. The market is a constantly evolving system. Inefficiencies are discovered, exploited, and then disappear. A successful quantitative firm cannot rely on a static set of models. It must be a perpetual research laboratory, constantly searching for new, faint signals and integrating them into the existing orthogonal system. This requires a culture that values empirical evidence above all else. The moment you stop searching for new edges, your existing edges begin to decay. In a traditional firm, a senior partner's opinion, based on decades of experience, often overrides the data. In our environment, the data is the only senior partner. If a model developed by a junior researcher contradicts the intuition of a seasoned veteran, the model is given precedence, provided its statistical validity is sound. This is the ultimate expression of the unemotional approach, the subjugation of human ego to mathematical truth. The only authority is the empirical evidence. The process of scientific inquiry in finance involves three critical steps. Hypothesis and data mining, the search for the faint signal. We start with a hypothesis, a potential inefficiency in the market. This is followed by rigorous data mining, not to prove the hypothesis, but to test its statistical significance. We are looking for patterns that are robust, persistent, and, crucially, have a plausible, if subtle, mechanism in the market microstructure. For example, a hypothesis might be that a certain type of large institutional order leaves a predictable short-term price distortion. We then use sophisticated signal processing techniques, often borrowed from physics and cryptography, to isolate this faint signal from the overwhelming market noise. We are not looking for coincidences, we are looking for causality. However faint, the data must speak for itself, and we must be prepared to hear that our initial hypothesis was wrong. The willingness to be wrong is the first step toward being right. B, backtesting and validation, the trial by fire. Every potential edge must survive a brutal process of backtesting against decades of historical data, followed by out-of-sample validation. The goal is to ensure that the pattern is not merely a product of data mining bias, a pattern that only exists in the historical data we used to find it. We employ techniques like cross-validation and walk-forward analysis to simulate real-world trading conditions as closely as possible. The model must prove its robustness across different market regimes: bull, bear, high volatility, low volatility. This process is designed to destroy weak hypotheses. Only the most statistically robust signals are allowed to proceed. A model that performs perfectly on historical data is immediately suspect. A model that performs just well enough consistently across all historical periods is a candidate for integration. C, integration and monitoring, the systemic deployment. The surviving signals are then integrated into the overall trading system, scaled appropriately to maintain orthogonality, and continuously monitored. Integration is a complex engineering task, ensuring that the new signal does not inadvertently interfere with the existing system. Once deployed, the model is monitored in real time. The moment a signal begins to decay, the moment its statistical edge drops below a profitable threshold, it is retired, without sentiment or regret. This is the scientific method applied to capital allocation: constant experimentation, ruthless validation, and the immediate discarding of failed theories. The system is designed to be self-correcting, to adapt to the market's evolution without human emotional interference. The retirement of a model is not a failure. It is a successful adaptation to a changing environment. The philosophical implication for you is that your investment strategy must be a living document, not a static belief system. You must be your own chief scientist. You must continuously test your assumptions, measure your results against a neutral benchmark, and be willing to discard any strategy, no matter how emotionally satisfying, the moment the data proves its statistical edge has vanished. The market is a relentless Darwinian environment. Survival is reserved for those who adapt, and adaptation is driven by empirical evidence. The $60 billion empire is not a monument to a single discovery, but a testament to a culture of perpetual, unemotional, scientific inquiry. This is the third great lesson. The market is a problem in physics, not a problem in psychology, and it must be approached with the rigor of a laboratory. The small edges that built the empire were not hidden in some arcane corner of the market. They were hidden in plain sight, obscured by the noise and the emotional bias of the human observer. The true innovation was not the discovery of the edges, but the creation of a system, a mathematical, technological, and psychological infrastructure that could systematically exploit them. This is the Jim Simons method. It is a philosophy grounded in empirical reasoning. It demands that you, 1, filter the noise, reject the narratives and the emotional drama of the market. Seek the faint, persistent, statistical signal buried in the data. Embrace the 50.7% solution and understand that quantifying the present is more valuable than predicting the future. 2, diversify the system. Do not rely on a single heroic trade. Build a portfolio of many small, uncorrelated, orthogonal edges that provide systemic robustness. Diversify not just assets, but strategies and time horizons. 3, execute without emotion. Codify your rules and execute them with the cold, hard discipline of a machine. Never let fear or greed override a statistically sound process. Understand that your greatest enemy is your own psychology. 4, embrace scientific culture. Treat your strategy as a living hypothesis. Continuously test, validate, and adapt, retiring any edge the moment the data proves its decay. Approach the market with the rigor of a scientist, not the fervor of a speculator. If you found value in this analytical approach, if the logic of the numbers resonates with you, I encourage you to like this video. It is a small signal to the algorithm that this message is valuable. More importantly, I want you to internalize this lesson. The small edge is not just about trading. It is about life. It is about the marginal, consistent effort that compounds over time. It is about the discipline of the process. It is about the relentless pursuit of truth, even when that truth is inconvenient or counterintuitive. In the comments below, write a single sentence about how you will apply the principle of unemotional execution to your own financial life this week. Will you stop checking the news? Will you pre-commit to a specific exit point? Will you define a clear, objective rule for a trade you are currently holding? Let me know the rule you will codify. The market is a relentless, unforgiving teacher. It rewards those who are patient, logical, and unemotional, and it punishes those who seek drama and quick riches. The path to lasting financial success is not a sprint. It is a marathon of small, statistically significant steps. Stop chasing the grand theory. Start building the robust system. The small edges are waiting for you, but they will only reveal themselves to the mind that is prepared to see them through the clear, unclouded lens of mathematics. Build your system, trust your numbers, and the compounding will take care of the rest. That is the only secret there is.